Marco Rubio is correct in his assessment to the extent that payment platforms continue to evolve in order to enable non-dollar based payments to, in lightning fast terms, be involved in transactions across countries, across the world, and not in US dollars. To the extent that that continues to grow, which it is, the ability just to process and to transact and to facilitate payments in dollars will be diminished. That's just the reality of the math. And that does not mean the dollar is going to go away. It doesn't mean the dollar is going to be replaced as the reserve currency throughout the world. Things don't happen that fast. That's not something that's going to occur in any way, shape, or form during this particular administration in 4 years. However, and I was privy to a lot of these conversations when I was in Rio during the outskirts of the G20 last November, which are continuing to happen, which is that payment systems, which are the bedrock of being able to trade in any currency, right, to establish funds going back and forth immediately and being convertible into whatever currency is involved or multiple currencies or whatever, however robust those systems are ongoing. And they are going to be connected to an extent more and more to central bank digital currencies, which are going to be connected to the People's Bank of China. There's already prototypes, which are going to be connected to the Central Bank of Brazil. There's already prototypes, which are going to be connected to the Central Bank of Russia. There are already prototypes, and they all are talking to each other and being tested. So this isn't something that might happen. This isn't something that's not in play. This is something where there are significant prototypical and growing platforms being established as we speak to allow the facilitation of transactions not in US dollars. What can the United States do about that? Well, they can't necessarily stop these systems or stop the ability of countries to trade with each other or to have multi or bilateral trade agreements with each other. They can tariff transactions that don't happen in US dollars, but there's really only so much that can really go if you're going to be going through a payment system that could possibly transact in multiple currencies in a nanosecond, and you can't even trace them, right? I mean, there's various different ways that this can go down that you cannot control. But what the United States can do is be involved in some of those platforms. So at the end of the day, if it wanted to, you're not just talking about a swift banking platform of instructions on payment systems that go out throughout the world between banks and central banks that can be sanctioned, as we have seen, but that you're involved in the development or the prototyping or the testing of these. Now, the United States actually is, as it happens, involved in one that the BIS is currently developing, which is a payment system, which also is in prototype mode, which is more centric to the US and G7. So there are things that the United States is involved in, and it will be interesting to see to what extent it maintains involvement so that it actually can be privy to the developments of these payment systems so that potentially simultaneously better, higher, faster quality payment systems are being developed, but one of them actually includes the US dollar. From a gold and silver basis, particularly gold, what we have seen is the second phase of what we saw with the first tariffs back in 2018. So what do we see back then? First of all, rates were much lower than they were now. They were about 200 basis points lower than they were now. Inflation was oddly similar to what it is now in PPI terms. It's not the best measure. It's not the only measure, but just on a graphical basis, pretty similar inflation, lower rates. But then tariffs came in, and there was a sort of conversation between Powell and Trump about Powell being concerned back then about tariffs increasing inflation, Trump really wanting lower rates at the time. Ultimately, rates went from 2.5% down to 1.5% going into 2019 before COVID. So ultimately, rates were reduced. Tariffs did kick in. There were inflationary pressures, not massive, but on a lot of prices for a lot of different goods in the wake of tariffs. But the bigger thing that happened with respect to gold was that People's Bank of China reinitiated their selling of United States treasuries. So going into that period, they've been holding about $1.3 trillion worth of treasuries. They're currently holding about $750 billion. So they've really diminished the amount of U.S. treasuries, U.S. dollars they are holding to liquefy international banking transactions that go through or that require the central bank to be involved. That's what they have done. In the place, they have purchased gold, not in a straight up line, but they've certainly increased the amount of percentage of gold reserves that they've had from under 2% to over 5.5%. Particularly in the last few months, they sort of ratcheted up their gold purchases. They're on a path towards 7% and so forth, reserves in gold over the next 1 or 2 years. That would be consistent with what happened in the wake of the last tariffs. So, do tariffs cause diversification of reserves and debt to gold? Yes. Are we in a period right now where more tariffs and potentially more volatility and uncertainty surrounding those tariffs will accelerate that move to gold? Yes. Why? Because everyone was at this movie last time, right? So there's already preparation, there's already a reduction in US debt, and there's already an increase in gold reserves and the desire to continue gold reserves. And as I mentioned, in the technology of payment systems to be able to transact not necessarily in gold, but to potentially have gold back some of them and transact in other currencies or under central bank digital currencies. So all of this is a kind of tit for tat global version of what can manifest and has manifested when tariffs become a political, economic, and geopolitical item. This doesn't mean they won't continue to be pushed by the administration, and it doesn't mean there won't be retaliation from the other side. And there can be diminishment, as you noted, with Canada and with other countries, depending on their own inflation scenarios, of interest rates and of currencies in order to accommodate the additional cost or competitiveness of tariff wars. And we did see that also last time around. So there's definitely the possibility for the dollar to sort of remain stronger, other currencies to weaken in this new iteration of a tariff fight, and also gold to appreciate relative to those currencies and to the dollar. The thing with the mining index is that it's basically a catch-all for all sorts of miners. So you're going to get your Agnicos in there, which are doing phenomenally well, hitting new highs right alongside gold. And then you're going to get other miners that aren't, and then you're going to get smaller miners that are hitting really well, like an Artemis or something like that on the smaller mine side, and then you're going to get one all in between. So where do we pick up that sort of Western investor? Now it's time for mines again that we did see pop out last October to an extent before the election, before gold traded off a little bit. Now it's back up at highs. When are we going to see that come in? And in order for that to come in, we need to basically see more volatility in the actual market, in technology, in your Palantirs, their Nvidias, and all these other things that we've been talking about. Because at the end of the day, as a percentage of an investment asset class, just overall, miners are still small compared to like Magnificent Sevens or Palantir or whatever. I mean, that's just a fact. That said, they can produce 2x, 3x, 5x, 10x returns. And so as this demand, which is accelerating for gold, continues, there will be a necessity to source more gold. Last year, what we saw was not necessarily that necessity yet. We saw those miners in the overall index pop up a little bit because of the expectation that since gold had already popped up, it would bring up all of the balance sheets of all of these miners quickly enough, and that didn't happen quickly enough, so we saw a bit of a sell-off. And that's where we're at right now, which I personally think is a big opportunity. I mean, right now, we're looking at a lot of smaller cap and middle cap miners because of preparing for the eventuality that if I look at the numbers, going back to the tariffs we're talking about, PPI, where gold was, where China was, where central banks were, where geopolitics were in 2018 relative to where we're at now, which is with so much more momentum for gold and so much more momentum for these things to expand outward and to magnify, is that I see gold going towards 4,000 towards the end of the year and towards 5,000 within a couple of years, basically just with all the math staying the same and all these parameters basically staying the same, and only China leading the way and going up from 5.5% of reserves to 7.5% reserves in 2 years and continuing this path for all of these reasons. And then everything else, all of the other reasons filling in. That's going to necessitate not just the central banks who are buyers of physical gold, not just their countries, their citizens who do what they do and buy physical gold or physical gold ETFs, which they are, but also it will require the miners that have high quality mines that are prepped and ready or already operating to be examined as the next part of that equation. So whether that is in 6 months or whether that's in a year, this is when you prep for that. This is when all of that impatience that people who do invest in mines, and it takes a minute to turn on a mine and create product and processes it in connection to demand, the same for silver, copper, uranium, etc. This is the time where you just kind of got to dig in and diversify your portfolio with the appropriate miners, and you will see that within, I would say, a year or so, you're going to see those indices overall pick up, whereas in between you're going to see specific miners outperforming others. It's a similar story to gold, except instead of looking at central bank buying, we're looking at all of these industrial demands that are magnifying. And there is, to an extent, a little bit of central bank buying because you can buy silver and use it as a reserve. But the point being that, as you've listed, there are a significant amount of silver products that do not have the appropriate supply of silver to manifest the growth and the momentum of the growth of their demand. And that's not going to go away. I mean, it's like saying China's going to sell all its gold. It's just not. There are certain things, robotics electronics are not going to stop. Medical uses are not going to stop. We're not going to stop requiring more industrial building in order to facilitate whether it's cars or data or permanent magnets, which require both, rare earths as well as the silver to actually create the manufacturing footprints and so forth. You're just not going to have that stop. We're not in a position from a sheer civilization standpoint where this stuff is going to go backward unless, the earth is hit by a meteor and it's game over for everybody and like other stuff happens. But as long as we're in this growth period, which we are, then little things, and this hurt silver to an extent last year, little things like, is our economy going to grow as fast? Is China's economy going to grow as fast? Things that sort of ding at silver or sometimes copper, which pop up, but they're periodic. That stuff's not going to go away. But the overall trend, the overall necessity of more silver than we actually have out of the ground yet is going to continue to pull demand for that silver. And it's, again, similar story to gold, which you're going to have silver miners who have quality silver, quality extraction services are in areas of the globe where there's more peace and there's more of an ability to, not have external issues of chaos sort of pop into the mining situation. All of that is going to make miners of pure silver, high quality silver in peaceful areas with appropriate technologies to extract and process at the top of this heap. And that is where you do look at these miners. Silver's had a great run up this month. Again, it was dinged a bit at the end of last year for these reasons. But the reality is, as much as it's a leveraged commodity and there's a lot of sort of play going on in terms of silver markets and the manipulations we hear about, the reality is to physically build things, you need physical silver. And there's just not simply enough physical silver to meet the demand that we have.